The silver price has risen from $20 to over $50. Now I think we were 90. Yeah, we're $90 now. These companies are going to be incredibly profitable in the quarters which follow. So going forward for the next 12 months, I think we're going to see quarter on quarter of rising prices.
I think there's kind of like a magnet up there pulling the price of gold, or a magnet down here pulling the dollar and all other fiat currencies, right? You can just turn it around. And unfortunately, I can't determine what the price will be towards, let's say, the top trend line. But, the last price here on the chart is $8,000 gold. You can still see it.
A dramatic turning point may be forming in global markets as gold and silver begin moving not merely as investments but as indicators of shifting monetary gravity. Observers watching recent price behavior see signals that extend beyond inflation hedging, suggesting a broader reassessment of currency stability and long-term economic confidence. Financial expert Clive Thompson and financial markets and macroeconomics analyst Mario Innecco describe the present environment as one where precious metals are transitioning from cyclical assets into structural benchmarks of financial trust. Clive Thompson explains that rising metal prices fundamentally reshape mining economics. When gold traded near lower ranges, large portions of underground reserves remained economically useless because extraction costs exceeded market value. With gold prices climbing dramatically and silver advancing multiple times above prior levels, deposits once considered liabilities have effectively turned into profitable assets. Mining companies now benefit from expanding virtual reserves, meaning higher prices alone increase what can be economically extracted without new discoveries. Recent market behavior also appears unusual compared to historical trading patterns. Periods traditionally associated with price suppression, particularly end-of-month trading sessions, have instead shown strength in both metals. According to Thompson, this suggests that long-term demand may now outweigh speculative short pressure. Gold holding firmly above major psychological thresholds and silver stabilizing at higher ranges implies that former resistance levels may become durable price floors. Rather than temporary spikes, these levels may represent a repricing phase reflecting deeper macroeconomic forces. Macroeconomic data reinforces these perspectives. Stronger than expected producer price inflation readings and ongoing electrification trends support industrial demand for silver, while currency debasement concerns continue to underpin gold's appeal. Innecco describes the market metaphor as either gold being pulled upward by valuation forces or fiat currencies drifting downward under expanding monetary supply. Long-term projections discussed in the analysis even consider scenarios where gold approaches substantially higher levels over several years, though both speakers emphasize uncertainty and disciplined positioning rather than certainty. If this insight added value for you, consider supporting the channel by liking the video, subscribing for future updates, and turning on notifications so you stay informed whenever new analysis is released.
Well, we've just passed the last day of February, the last working day of February, and it was a Friday, normally a smackdown Friday, and that would have been the perfect day for the shorts to smack the price down. But the price of gold and silver rose this Friday, unusually, so basically the shorts failed to outwit the longs as they often do at the end of the month or on a Friday. Gold has now established itself above $5,000, well above. It's a couple of $100 above that now. And I think this $5,000 and higher is the new norm. And silver looks like it's established itself above $50. So I think this wasn't a fleeting move as we moved above these levels. It looks like it's going to be permanent. I think that these are the new lower levels and they're holding. So for years, the conversation regarding gold or silver was about the rising prices of everything, retail prices, consumer prices. It was about the shrinking purchasing power and how you could stay ahead of inflation. But that discussion has now evolved. The discussion is no longer just about inflation, it's about confidence. Confidence in currencies, confidence in debt, or rather government debt, and confidence in the system itself. Gold and silver have always been money. Empires have risen and fallen. Currencies have been printed, debased, devalued, destroyed. Yet precious metals have endured. They've survived kingdoms, wars, revolutions, political upheaval, natural disasters, inflation, hyperinflation, invasions, confiscation, seizure, and taxation. Somehow, those who could hang on to their gold came out the other side as well off, if not in many cases, much better off than they were before the situation arose. These people, these smart cookies who had gold and silver, did not depend on trust in a government. They didn't have to rely on the promise of some central bank. They're both scarce and, of course, universally recognized. And I can promise you, if we go into some sort of currency chaos, everybody's going to learn very, very fast. People will wise up extremely fast what the value of an ounce of gold is or an ounce of silver. Central banks, both large and small, are increasing the gold in their reserves. At the same time, they're very quietly reducing their exposure to the US dollar. With American debt climbing higher and higher relative to GDP, the debt is growing much faster than the growth in the economy, or much faster than the growth in the gross domestic product. The monetary authorities around the world are now preparing for a future in which the dollar may not be the unquestioned reserve currency. We don't have panic yet, at least not now, but they are positioning themselves. And prudent individuals, like you, my viewers, are also doing the same. Now, gold and silver, quite different. Gold has the advantage of portability. It concentrates a great deal of wealth into a very small, discrete form. In times of war or crisis, those who are forced to flee are far more likely to carry a handful of gold coins than they will lug a suitcase full of silver coins. When mobility matters, when you've got to go somewhere in a hurry and hide it, gold offers density, discretion, and convenience. Silver, however, plays a different role. In a world where the monetary system is faltering and everyday transactions return to some sort of tangible exchange, silver is far better suited than gold for that purpose. Its lower unit value makes it practical for day-to-day trade, for swapping for food or fuel or services or commerce. And we also know that virtually 100% of all the silver produced each year is consumed. So there is no doubt that a short squeeze is underway. We've seen in the last few years this deficit of silver, which has been met by the above ground stocks of silver, recycled silver, by people selling back their silver. Silver's come out of the woodwork to meet that demand, but of course that's caused the price to go higher, because to get that silver, the silver which is needed by industry, you have to bid up. So someone says, oh, I like the price, and they go down to the coin shop or they go down to the smelter with their candlesticks and try and get some extra money for them. In my view, there's a short squeeze underway. Let's look at the inventories around the world. Shanghai silver, that's down to just 306 tons as of the 27th of February this year. To put this in perspective, in January 2021, the figure was over 3,000 tons, 10 times as much. Or another way of looking at it, 90% of the silver held in the Shanghai exchange has now gone. If we look at the LBMA, the amount of silver in the LBMA, although it's been rising in the last few months, it is still only half what it was in 2021. And last but not least, the inventory in COMEX is literally falling off the edge of a cliff. So the gold to silver ratio, which was about 100 to 1 a month or two ago, still about 60 to 1 or 57 to 1, something like that, looks like it's on its way to perhaps 10 to 1. I don't know where it'll end up. But the gold to silver ratio looks like it's going to get better. Now, what does that mean? It means that silver should perform faster than gold and at a better pace than gold.
Mario Innecco shifts the focus away from inflation alone toward confidence dynamics. He argues that the discussion surrounding precious metals has evolved from protecting purchasing power to questioning the durability of sovereign debt systems and fiat currencies. Central banks increasing gold reserves while gradually reducing reliance on the US dollar reflect preparation rather than panic. Governments face debt growth exceeding economic expansion, creating conditions where diversification into tangible reserves becomes strategically attractive. In this framework, gold functions as concentrated portable wealth, while silver serves a complementary monetary role tied to everyday exchange potential. The distinction between the metals becomes central to their combined outlook. Gold's portability allows significant value storage in compact form, making it historically attractive during crises or displacement. Silver, however, carries transactional advantages due to its lower unit price, making it practical for smaller exchanges should financial systems face stress. Analysts suggest this dual functionality may allow both metals to rise simultaneously but for different economic reasons, one driven by reserve demand and the other supported by industrial and monetary utility. Supply conditions strengthen the bullish narrative presented in the discussion. Nearly all newly mined silver is absorbed by industrial applications, leaving limited surplus inventories. Let's get back to the video.
So back to India. And I think it's really important because you look at India and China, they've got 2.8 billion human beings in those two countries. So that's more than a quarter of the world's population. And, well, I don't have to tell you how China is growing and becoming a challenge to the United States economically. India is still far behind. There's still a lot of inequality and poverty in India, but it's a growing country. I think some people say that it's got the biggest middle class in the world, just because of the sheer numbers of the population. Yeah, it's interesting because in the bull market in gold and silver, the 70s, and early 80s or up until 1980, China and India weren't really a big part of it because China was still backward economy under the thumb of authoritarian communism. It wasn't capitalist at all as it is now. And India was still very poor. It hadn't really developed as much as it has now. So this is pretty important, not just to my American viewers, but to my European viewers who sometimes ignore the importance of not only China, but India. And this is why these two stories that I'm going to go over are really important. So the first one is about the price mechanism, price setting, or what kind of valuation they use. And this came out yesterday, and I've got the story from investing.com. It says India regulator shifts gold silver valuation rules for mutual funds. India's Securities and Exchange Board directed mutual funds to use domestic stock exchange spot prices to value their physical gold and silver holdings from April 1st, 2026. What's interesting about that date as well, I guess maybe it's their tax year, but it probably is because it's a new tax year for companies in the UK as well. And seeing that India was a colony prior to 1948, they might have kept the same kind of system. But the other thing about April 1st is that this is when India is gonna allow silver to be used as collateral for loans for individuals and for companies. So this is quite interesting, isn't it? But let's continue. It says the regulator said on Thursday that mutual funds may now use pulled spot prices from recognized stock exchanges that settle physically delivered gold and silver derivatives contracts, ensuring that valuations reflect domestic market conditions. The change moves away from the currently used London Bullion Market Association prices to arrive at the valuation of gold and silver held by exchange traded funds. That's a vote of confidence, no confidence, excuse me, on the LBMA and also COMEX for that matter. China already doesn't really use LBMA nor COMEX anymore. Shanghai Gold and Silver Gold Exchange and the Shanghai Futures Exchange, that's where they set their prices. They're all derivatives, but physical markets, unlike in the West. And well, too bad for the LBMA and COMEX. They're going to go, well, they're probably not going to disappear, but they're going to be like a marginal place. And I would also speculate that a lot of silver miners especially, but also gold miners, they're going to start using more international prices to set the sale of their raw materials, i.e. gold and silver. Because why should a silver company that's working hard to mine silver sell it for a price that's it doesn't reflect reality, right? If they can sell it in China and India for $10, $12 more, I think there's kind of like a magnet up there pulling the price of gold, or a magnet down here pulling the dollar and all other fiat currencies, right? You can just turn it around. And unfortunately, I can't determine what the price will be towards, let's say, the top of the top trend line. But, you know, the last price here on the chart is $8,000 gold. You can still see it. But if you go forward 2-3 years, you can see what the potential is. And I think this is why I'm sitting tight and holding on to my gold and silver, and also considering some speculation. What kind of speculation? Well, the miners are speculation, right? And with that, I wanted to update you on Chancery Royalty. Yeah, it's speculation. Everything in life is speculation, but it's a lot riskier speculation. So, yeah, mining investment, any kind of investment, needs to be taken very seriously. A lot of research has to be done, and this is not financial advice, of course, from me. I'm just telling you what I'm doing and the way it works with Chancery, yes.
Declining stockpiles across major exchanges and increasing recycling activity indicate tightening availability. Innecco interprets these developments as early signs of a potential supply squeeze, where rising prices become necessary to draw additional metal into circulation. The shrinking inventories also contribute to expectations that silver could outperform gold if the gold-to-silver ratio continues narrowing. Global market structure changes add another layer of complexity. India's decision to value precious metals using domestic spot pricing and to allow silver as lone collateral signals growing regional influence over price discovery. China's preference for locally settled exchanges further illustrates a gradual shift toward multipolar pricing mechanisms. Analysts believe miners may increasingly sell metals based on physical demand in Asia rather than traditional Western benchmarks, potentially altering long-standing valuation dynamics. Together, Thompson and Innecco present a framework built on interconnected developments: rising mining profitability, evolving confidence in currencies, tightening silver supply, and shifting global pricing power. As global demand, monetary policy, and industrial consumption converge, could the next phase of the metals market redefine how investors measure value itself in an increasingly uncertain financial system? If this discussion gave you useful perspective, be sure to like the video, subscribe to the channel, and share it with anyone keeping an eye on the gold market. Appreciate you watching. Stay informed, stay thoughtful, and see you in the next update.